Welcome to VeriScope News. We provide verified reporting. We deliver clear context. Our mission is to provide a neutral, calm, and advertiser-safe perspective on the economic forces shaping our world. Today, we are conducting a comprehensive investigation into the United States labor market. We will examine the final data for 2025 and the emerging trends of 2026. This is a deep dive analysis intended for growth strategists, investors, and informed citizens. The labor market is the ultimate lagging indicator. It reflects decisions made by thousands of business owners and corporate boards months in advance. As we conclude 2025, the American workforce is at a historic crossroads. We are seeing a phenomenon that challenges traditional economic theory. Usually, when hiring slows to this degree, unemployment rises sharply. Instead, we are seeing a stagnant but stable environment. This matters because it changes how the Federal Reserve manages interest rates, it changes how households plan for the future, and it changes how businesses allocate capital. To understand why 50,000 jobs is a significant number, we must look at the structural changes in how companies operate today versus a decade ago. We are transitioning from a labor-intensive economy to one driven by efficiency, automation, and high-specialization service sectors. The Department of Labor's December report confirmed that employers added exactly 50,000 jobs. This is nearly identical to the revised November gain of 56,000. These figures represent a significant deceleration. For the full year of 2025, the U.S. economy created 584,000 jobs. This is a 70% decrease from the 2 million jobs added in 2024. Despite this, the unemployment rate slipped to 4.4%. This tells us that while new roles are not being created, existing roles are being preserved. We must also look at the revisions. October's data was revised lower for a second time. It now shows a loss of 173,000 positions. This volatility is largely due to the 6-week government shutdown that occurred in late 2025. The Bureau of Labor Statistics struggled to collect timely data during that period. Now that the data has stabilized, the picture is clear. The manufacturing and retail sectors are under pressure. Manufacturing has shed jobs every single month since April. This coincides with the announcement of the Liberation Day tariffs. Retailers, meanwhile, cut 25,000 jobs in December. This is highly unusual for the peak holiday season. It suggests that the traditional model of seasonal hiring is being replaced by automated logistics and e-commerce efficiency. To understand the current slowdown, we have to look back to the era of 2003. That was the last time the U.S. saw job gains this low outside of a recession. In 2003, the economy was recovering from the dot-com bubble and the 9/11 shocks. Today, the causes are different. First, we have the Liberation Day tariffs. These duties were designed to bring manufacturing back to the U.S. However, the immediate effect has been an increase in input costs for manufacturers who rely on global parts. Second, we have the demographic cliff. The American population is aging. Millions of baby boomers are retiring every year. The labor force participation rate is stable, but the total number of people entering the workforce is not growing as fast as it once did. Third, we have the interest rate cycle. The Federal Reserve kept rates elevated for most of 2024 and 2025 to fight inflation. High rates make it expensive for businesses to borrow money to expand. Finally, we have the AI effect. In 2025, companies across the country began integrating generative artificial intelligence into their daily workflows. This hasn't led to mass layoffs yet, but it has drastically reduced the need for entry-level hiring. A task that once required 3 junior employees can now be managed by 1 senior employee using AI tools. This is a structural shift that will likely define the labor market for the next decade. Deep impact analysis. Let's examine the impact on household finances. For the 95% of Americans who are currently employed, the market feels safe. Layoffs are at historic lows. This creates a sense of stability. However, this stability has a hidden cost: wage stagnation. When hiring is slow, workers have less exit power. They are less likely to quit for a higher-paying job because they know the options are limited. This reduces the upward pressure on wages.
For the average household, this means that while their income is secure, their ability to get ahead of inflation is diminished. We're seeing a plateau in middle-class income growth that mirrors the plateau in hiring. Regarding prices, the labor market is working in the Federal Reserve's favor. One of the biggest fears of 2024 was a wage price spiral. This is where high wages lead to higher prices, which lead back to higher wages. With hiring at $50,000 a month, that spiral has been broken. This is a signal that inflation is likely to remain moderated in 2026. For consumers, this means the prices of services like insurance, dining out, and healthcare should stop rising at the aggressive rates we saw last year. For the job market itself, we are seeing a K-shaped divergence. On one side, we have essential growth sectors. Healthcare added 38,500 jobs last month. This sector is immune to tariffs and AI-driven job loss because it requires physical, human presence. On the other side, we have exposed contraction sectors. Manufacturing and retail are suffering. If you are a worker in an exposed sector, your job security is lower and your career mobility is currently near zero. This divergence is creating a regional imbalance. Cities that rely on healthcare and hospitality are thriving. Towns that rely on traditional manufacturing are feeling the first signs of a local recession. The impact on savings is also profound. When the labor market is slow, people tend to save more out of caution. This is known as precautionary savings. However, because interest rates are still relatively high, these savings are earning a decent return. If the Federal Reserve sees this data as a reason to cut rates aggressively, those returns will vanish. Savers will be forced to move their money into riskier assets like stocks or real estate to maintain their wealth. This could lead to an asset bubble in the latter half of 2026. For businesses, the current environment is a test of productivity. Corporate America is currently producing more goods and services with fewer people. Productivity increased by nearly 5% in the third quarter of 2025. This is excellent for profit margins. It is why the stock market has remained resilient despite the hiring slump. Businesses are finding that they don't need to hire to grow. They are optimizing. They are using software. They are refining their supply chains. For a business owner, the goal in 2026 is not to be the biggest employer, but the most efficient one. This is a fundamental change in the American corporate mindset. There are three specific signals experts are monitoring. First is the quit rate. This is a measure of how many people are voluntarily leaving their jobs. If the quit rate drops further, it means workers have lost all confidence in the market. This would be a precursor to a consumer spending slowdown. Second is the service sector PMI. We know manufacturing is struggling, but as long as the service sector remains in expansion territory, the overall economy will avoid a recession. Third is the impact of the 2026 tax refunds. Because of the tax legislation passed last year, households are expected to receive larger than normal refunds this spring. Experts are watching to see if this money goes towards paying down debt or if it sparks a new wave of consumer demand. For the viewer, this data suggests a time for financial defensive positioning. It is not a time to take massive career risks. If you have a secure position, maintain it. Use this period of stability to upskill, particularly in areas where AI cannot compete, such as complex problem-solving and human-centric services. If you are an investor, look for companies with high revenue per employee ratios. These are the companies that will thrive in a low-hiring, high-efficiency economy. Do not let the headline of 50,000 jobs alarm you. Instead, see it as a sign that the economy is maturing and finding a new, slower, but more sustainable baseline. Hidden pacing buffer. The Bureau of Labor Statistics utilizes two primary surveys to generate this report, the Establishment Survey and the Household Survey. It is important to understand the discrepancy between them. The Establishment Survey counts jobs, but the Household Survey counts people. If one person has 2 part-time jobs, the Establishment Survey counts that as 2 jobs. This is why sometimes the job growth looks better than the reality of the people's lives. In December, we saw a rise in multiple job holders. This suggests that while 50,000 jobs were added, the number of employed people might actually be stagnant. Furthermore, we must consider the birth-death model. This is a statistical adjustment the government makes to account for new businesses being born and old businesses dying. In a slow economy, this model can sometimes overestimate job growth by assuming new businesses are being created at a rate that isn't actually happening. By peeling back these layers, we can see that the labor market is even more fragile than the surface numbers suggest. The labor market is the foundation of our economic reality. At VeriScope News, we remain dedicated to bringing you the facts free from hype and full of context. We thank you for your continued trust. Stay informed, stay calm, and we will see you in the next report.